When we look at owner remuneration and profit extraction, one needs to consider the tax effects of salaries, drawings, dividends, and loan accounts, depending on the structure of the business. Remember, if paying dividends, these are after the 27% has already been paid on the profits of the company, and then a further 20% dividends tax is paid before paying over the dividends to the shareholders. Therefore, it's an effective 47% tax rate is paid on dividends declared versus a 45% maximum tax rate on a salary declared. This flexibility of deciding whether dividends or payroll should be actioned to reap the benefits of your business is, however, only available to owner-managed businesses when all shareholders are active in the business, as dividends are paid equally to all shareholders in line with their shareholding. Often overlooked is the repaying of any loan accounts that are owing to the business owner. This does affect cash flow, but no tax is applicable, and therefore does not affect the taxable income either. Many clients want to repay loans thinking it's a business expense and that it will reduce their tax liability, but it isn't. It affects the balance sheet and therefore no tax expense benefit. Just worth remembering, if there are loan accounts before declaring dividends, settle the loans before doing the dividends if you're an owner managed. The documentation and governance is crucial, and therefore the keeping of contracts, resolutions, source documents, and tax calculations is a non-negotiable. Good records are one of the strongest forms of tax risk management. SARS have gone back as far as 2002 for one of our clients recently, where they asked for the proof of the PAYE that was deducted, and if we couldn't prove it, he was going to be liable for that PAYE. So we had to get bank statements going back to 2002 as well as pay slips to prove that it was deducted and the net amount went into his bank account. So 5 years is not applicable. 10, 15, 20, and even longer is what SARS are looking at.